Do you want to know how to sell a stock like Warren Buffett and Charlie Munger? These two legendary investors have made billions of dollars by buying and selling stocks. But they don't just sell stocks for any reason. They have a particular process for deciding when to sell. What's that process? In this video, we will reveal how Warren Buffett and Charlie Munger decide when to sell a stock. Do they just sell when the stock price goes up? Or do they have a more specific process? Let's find out. Selling a stock can be one of an investor's most challenging decisions. As Warren Buffett aptly states, the perfect time to sell a stock is a question that perplexes even seasoned investors. When the stock market is teeming with opportunities and the tides of finance ever shifting, knowing when to make that crucial move is akin to navigating through treacherous waters. The 3 reasons investors sell. Let's first discuss some reasons why people sell stocks. Number 1. Capitalizing on gains. Now imagine an investor named Mike. He personifies the average investor, and like many, Mike sells stocks for various reasons. One common motive to sell stock is that the stock's value has surged, enticing him to cash in on the profits. This instinct seems rational, as the adage "nobody ever went broke taking a profit" echoes in his mind. Yet, timing is not always so straightforward, as we'll soon see. Warren Buffett echoes this sentiment, reminiscing on his earlier days when he had more investment ideas than money. He notes that selling a gain stock allowed him to seize even more promising opportunities. The idea here is to recognize when another investment offers more potential returns and have the wisdom to take that opportunity. Number 2. Breaking out of the flatline. Mike's second reason to sell arises when a stock's performance stagnates. He bought the stock a few months ago, but its price hasn't budged significantly. Mike feels the itch to join the rush of trendier, riskier investments like Bitcoin, spurred by friends' success stories. Frustrated by the stagnant stock, Mike makes impulsive decisions, unaware of the pitfalls that lie ahead. Warren Buffett emphasizes the importance of evaluating the business fundamentals rather than succumbing to short-term market trends. He warns against trading in and out of stocks due to the allure of trendy investments, as this can lead to misguided decisions driven by FOMO rather than rational analysis. Number 3. Yielding to market fear. Mike's third motive stems from market anxiety. After thorough research, he invests in a promising company, only to see its stock plummet inexplicably. Mike's confidence wavers, and he succumbs to the fear of missing crucial information. He sells the stock, only to watch it recover and thrive while lamenting his hasty decision. This fear-based selling often stems from viewing stocks as detached entities rather than ownership stakes in real businesses. Buffett and Munger echo the sentiment of seeing stocks as ownership in businesses. Buffett uses the example of the newspaper industry, where technological advancements shook the industry's economic landscape. Instead of making knee-jerk decisions based on fear, they advocate for a deeper understanding of a company's changing dynamics and whether its competitive edge remains intact. Viewing stocks as businesses, Buffett and Munger's wisdom. Charlie Munger says, "We're partial to putting out large amounts of money where we won't have to make another decision. If you buy something because it's undervalued, then you have to think about selling it when it approaches your calculation of its intrinsic value. That's hard, but if you buy a few great companies, then you can sit on your ass. That's a good thing." Warren Buffett and Charlie Munger aren't just your run-of-the-mill investors, they're like the rock stars of the stock market world. Their approach to selling stocks is like a carefully choreographed dance, inviting us to join the party. These guys don't see stocks as mere numbers on a screen. Nope, they view them as ownership stakes in real, tangible businesses. It's like owning a piece of that neighborhood ice cream truck you loved as a kid. Buffett's got a gem of wisdom to drop here. Many investors miss the forest for the trees. They get tangled in the web of short-term market predictions, forgetting the whole point of investing, nurturing ownership and growth. Now let's talk about reason numero uno to sell: the hunt for a better opportunity. Buffett's got a tale from his early days when his pockets were bursting with investment ideas, but his wallet was playing hard to get. So what did he do? He decided to play matchmaker, introducing one stock to another, and voila, a match made in investment heaven. He sold one stock dancing in the green and snagged a more promising partner. This is where the opportunity cost concept struts onto the stage. When one investment can boogie better than the rest, it's time to change dance partners. And let's not forget, Buffett's not just talking the talk, he's walking the walk. Back then, he was flipping stocks like a pancake chef at a bustling diner. But he wasn't selling just for kicks, he was chasing those golden opportunities. It's like trading in your old clunker for a shiny new car with all the bells and whistles. Buffett's sales weren't just about making money, they were about making smarter money. But what if the business fundamentals start doing the cha-cha in a new direction? That's reason number 2, changing fundamentals. Buffett's like that wise uncle who tells you that if something ain't right, it's time to step back and reevaluate. He's not just playing lip service, he's been there, done that. Remember his little fling with the newspaper industry. The Buffalo News was like his cash cow, udders overflowing with profits. But then the internet barged in like a bull in a china shop, leaving the newspaper industry shaking. That's when Buffett realized that sometimes it's time to pack your bags and move on, even if it's bittersweet. Now let's explore diversification. Think of it as the investing equivalent of not putting all your eggs in one basket. Buffett and Munger aren't fans of the all-in approach. They've seen that movie before, and it usually ends with a box of tissues and a tear-soaked portfolio. Imagine investor A, who let one stock hog 40% of his portfolio like a greedy little cookie monster. Buffett and Munger would say, "Hold up, cowboy. Selling to maintain balance and diversity is like feeding your portfolio a well-rounded meal instead of junk food." But here's the twist, Buffett and Munger aren't cheerleaders for a stock-selling frenzy. Nope, they're more like the old-school romantic poets of investing. They believe in long-term relationships with stocks, where you hold on tighter than a squirrel clutching an acorn in winter. Frequent selling might make your portfolio look flashy, but it could also skyrocket your tax bill. Buffett's been practicing this holding period thing since before you even knew what a stock was. He's the grandmaster of buy and hold, a sage who knows that holding onto a stock like a lifeline might just make you richer in the long run. And Warren Buffett also says it is occasionally possible for a tortoise content to assimilate proven insights of his best predecessors, to outrun hares that seek originality or don't wish to be left out of some crowd folly that ignores the best work of the past. This happens as the tortoise stumbles on some particularly effective way to apply the best previous work or simply avoid standard calamities. We try more to profit from always remembering the obvious than from grasping the esoteric. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. While this investment style might not yield the same returns as investing in high-growth stocks, the enduring success of Munger and Buffett attests that adopting a straightforward strategy of selecting the market's premier compounding entities and retaining them over the years engenders considerable wealth over the long haul. Beyond delivering impressive returns, this approach minimizes the risk of making untimely selling decisions or reallocating funds from a good investment to a subpar one. In essence, Charlie Munger's most valuable advice on selling stocks can be summarized: don't invest in stocks you might feel compelled to sell in the first place. By investing in high-quality compounding entities and overlooking them, you unlock yearly returns without the need for prolonged assessments of intrinsic value or timing of sales. After all, once you sell, you must identify an equally enticing opportunity, and such exceptional prospects are scarce. If you've secured shares in one of the finest companies at an attractive price, why go through the trouble of selling? So, next time you're itching to hit that sell button, pause and ponder the wisdom of Buffett and Munger. They're not just stock market legends but the Yodas of investing. They've shown us the path to making smart, calculated, and strategic moves in the ever-changing world of stocks. Let's wind up things here. We hope you found the video interesting and valuable. So why not smash that red subscribe button and hit like to keep yourself notified with every video from us. See you in the next video.